Hey everyone, it's Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. Sorry for the slight delay, tech glitches with the audio, so we're back now and it works. I hope you can hear me. We do this thing almost every month on the last Friday of the month at noon Pacific time. That's when it's live, like right now. You can listen in online, or we'll post the show later to YouTube and you can watch it recorded. We skip a few months if it collides with a tax filing deadline or Christmas or stuff like that. This month, we're going to talk about our favorite newest tax law, global intangible low-taxed income. This this is an overviewy kind of high level thing, just so you can understand how the thing bolts together. We're not going to get nerdy on this one, because there are plenty of opportunities for nerdiness. But yeah, we'd be here all day. So let's get started. By the way, I'm going to be having a Q&A after this session on a Zoom channel. Rachel's going to be throwing the link into the chat field, and so you can join us, and that'll run for about 30 minutes afterwards for Q&A. We can't keep this thing open because otherwise that burns up CalCPA's time and money. So we just spin up a free Zoom channel afterwards. Anyway, let's go. Here's where we are in the series so far. So we've handled at the beginning who has to file a Form 5471, and we are midway through the income items. So if there is a controlled foreign corporation, how can this create taxable income for a shareholder? Last month was Subpart F income. This month is global intangible low-taxed income. And next month, we'll be talking about distributions from controlled foreign corporations, dividends and funds, deemed dividends and fun stuff like that. And then we'll end up, the last four episodes will be, now that we've got some damage and some tax liability, how can we mitigate that damage in a variety of ways? Table of contents for today, so you can read it later if you want to. And let's get going. First, let's start really super high level. I threw this into the newsletter that went out this morning, but I just want to run over it because I think it's really important to understand why Section 951 Cap A exists and why was it put in place. Because as I said in the newsletter, when the Tax Cut and Jobs Act was still foisted on us way back in 2017, it's a long time ago by now, huh? I thought, oh, these ratbag bastards, they're just taxing us some more with this Section 951 Cap A. Well, it's really not that way at all. It's Section 951 Cap A in global intangible low-taxed income is really an attempt to plug a loophole that was deliberately created on purpose by Internal Revenue Code Section 245 Cap A, which is a dividend received deduction. And so this is a common way that you see tax law evolve, action, reaction to the reaction, and so forth, second and third and fourth effects. So here's what it is. In the bad old days, we had a worldwide tax system. So you have a US multinational, they have foreign subsidiaries. The E&P of those foreign subsidiaries is going to be taxed to the US shareholder. The game that we played way back then was avoid Subpart F, which makes the E&P immediately taxable. And if you do that, then the earnings and profits of that foreign subsidiary are deferred until the shareholder chooses to trigger a distribution of E&P, aka a dividend, back to the United States, at which point there would be taxable income. Well, this had some positive effects and negative effects. The downside is that there was a disincentive to bring those offshore profits back to the United States. So you had all of these articles about Apple and Google and all the big multinationals having hundreds and hundreds and hundreds of billions of dollars of unrepatriated profits, and the cash is sitting offshore. And what are they going to do with it? Well, they're going to invest offshore and recirculate it. So they have massive pools of capital that build up the economies of other countries, but not the United States. And this is bad because politicians lose votes when people don't have jobs. And so that's not good. So what they went to is this thing called a territorial tax system. And in its Platonic ideal, they assume a spherical cow, weightless and, in outer space floating. The territorial tax system says the tax authorities will tax income earned within the territories, within the boundaries of the United States, and any income that you make outside the boundaries of the United States, you don't pay any US income tax on. So that's the classical definition of a territorial tax system. In reality, we don't have that. We have a mishmash of BS. So because this idea of a territorial tax system creates a vast incentive for you to move all of your business operations outside the United States, generate foreign source profits, and never pay a nickel of tax in the United States. So they deliberately decided that we're going to go for tax purposes to this territorial system. And the way that they implemented it is by creating a dividend received deduction. So if you have a US C Corp that has a foreign subsidiary, the dividend coming upstream, which contains earnings and profits in it, because by definition, a dividend is an embodiment of earnings and profits from the corporation that's paying the dividend, you get an offsetting 100% dividend received deduction and therefore no taxable income for the US shareholder. So this is how you effectively and practically get foreign profits upstream into the United States with cash attached, and there's no corporate level income tax for the corporate multinational receiving, getting all this money. Now all the money's in the United States and they can go build a factory in Ohio, and then everybody gets votes and whatever else happens in politics. So, jargon alert. So I've talked to you about what a territorial tax system means. This phrase, participation exemption. The idea that the reason they call it this is because the exemption part is, well, the foreign profits are exempt from tax. And participation, I guess, means because the US multinational parent company is participating in the profits of the foreign subsidiary, tax-free, exempt or tax exempt. So anyway, that's all that means. And really, it's kind of fun to see how this hand-wavy BS that you hear from talking heads on TV about territorial tax systems and participation exemption, how it actually gets embodied, and you can find it in the Internal Revenue Code. And there it is, 245 Cap A. So here's the before and after. Before the Tax Cuts and Jobs Act, you'd have an active business doing active stuff outside the United States, so its profits are not subpart F income. And then the subsidiary would pay us dividend upstream. The dividend has earnings and profits in it. So classic definition of subchapter C, section 301C1 says it's a dividend, parent has taxable income. Easy. Afterwards, we have the same thing. You've got income that's not subpart F income. So we don't have immediate inclusion of that income into the shareholder parent co. So we have untaxed earnings and profits that are paid upstream as a dividend, and the parent co has dividend income. What that means, then we apply section 245 Cap A, little parentheses A, and that creates an offsetting and equal dividend received deduction. So taxable income is zero. So you have plus 1,000 minus 1,000, taxable income zero. Easy done. Easy to understand. No, too far. This creates a problem. So now think about this. We're looking at this idea of base erosion. Income always wants to go to the lowest tax location. So if you have a choice between income being earned by a domestic C corporation, tax of 21%, or you have that same business activity and income from foreign sources earned by a foreign subsidiary, passed upstream with the dividend received deduction and effectively getting a US tax of 0%, well, you know what you're going to do. And just like water running downhill erodes the hillside, this incentive is something that happens. Well, something happens in a CFO's head, right? And they say, oh, this is interesting. And they busily shift all of the assets and activities to a foreign subsidiary where it can be taxed at 0%. And this is what's called base erosion. The assets that generate income and the business activities that are in the United States are moved outside the United States. And so the tax base of the United States is eroded, and future tax collections by the US Treasury are reduced, which is a bad thing. So we have Section 245 Cap A created the territorial tax system. Yay, good. For every up, there's a down. It created base erosion incentive for taxpayers. And so that's bad from the government's perspective. So 951 Cap A comes in here to make base erosion type of activities less economically valuable. So in abstract, before we add Section 951 Cap A in, which causes some of that foreign subsidiary earnings and profits to be taxable, the delta between tax, at 21% and tax at 0 is pretty big. When we add this Section 951 Cap A in, some of the foreign subsidiaries' earnings and profits are going to end up being included in the shareholder's gross income as global intangible low-taxed income and get taxed. So we are going to reduce the delta between today's world of 21% tax liability and 0 to something else. And the way it works right now, it's impossible to say a number, but because as you'll see, there's a fraction in there that depends on reality of the corporation's existence and what assets it owns and things like that. But you're going to end up with some of those earnings and profits are going to be tax-free, passed upstream, and protected by Section 245 Cap A. And that's going to be net deemed tangible income return. Boy, the phrases in here are nuts. And some of the earnings and profits are going to be taxable, which is the global intangible low-taxed income. So that's how they get to it. And depending on what your depreciable asset base is, you're going to have a lot of the tax-free stuff and only a little of the taxable stuff, or vice versa. So ignore the details for now. Just understand that Section 951 Cap A is designed to reduce the difference between the 21% default tax rate on corporations and 0, which is the platonic ideal of territorial tax systems. And by reducing the delta, it reduces the economic incentive for US multinationals to do silly stuff that hurts the US Treasury in the long run. So that's why 951 Cap A exists. And it becomes complicated because it's a sort of the book of Daniel, right? The wheel, or is Ezekiel? I don't remember. The wheels within wheels within wheels. 951 comes in and it creates some additional tax liability for moving all of your stuff overseas into a foreign subsidiary. But there's some holes in that. And so, we'll talk about it later when we talk about net deemed tangible income return. You can play fun and games with that, either by grouping all of your depreciable asset acquisitions on December 31, so they have a countermeasure for that, or by larding yourself up with a lot of debt and generating some interest income expenses and creating, over too much in the government's eyes, tax-free income. And so there are countermeasures there. But so when you look at the tax law here and throughout the code, it's just this game of we open the door, we close the door. Oops, we close the door too much. We'll open it a little bit more. And back and forth until there's just enough friction to give taxpayers incentive enough to do what the government wants them to do. That's the whole game. So now here's what it looks like, the after on the right-hand side. Some of the earnings and profits will be included in gross income of the U.S. parent company. And that's how they get the tax liability. And the dividend will be passed upstream. The E&P that's not taxed will be passed upstream and protected by Section 245 Cap A. For the E&P that is taxed, this is the same idea that we see in Subpart F, which is you can pay previously taxed earnings and profits upstream, and the receipt of that dividend, which is from earnings and profits after all, is excluded from gross income by Section 959. So the combination of these two means that in the long run, we will be able to move all the earnings and profits upstream and put it in the parent company's bank account in some tax-free manner, but some of the earnings and profits are going to be taxed no matter what. So there's a little rambly explanation of why things are the way things are. But let's get into some details here. First, I just want to give you a little highlight of there's a slight but important difference between the income inclusion rules of Section 951 Cap A, how much of that earnings and profits in the foreign subsidiary is going to be pushed up into the 1120 of the parent company. So there, what 951 Cap A applies to is not quite the same as what the dividend received deduction applies to. So two conditions for gross income inclusion are the taxpayer is a United States shareholder, and the corporation is a controlled foreign corporation. We know what these are from previous times. A United States shareholder has 10% or more of the stock by voter value. Controlled foreign corporation, United States shareholders collectively hold more than 50% of the stock by voter value. In contrast, 245 Cap A says you get a dividend received deduction. What kind of corporation? A specified 10% owned foreign corporation. And again, I don't want to go into the weeds here on what that means, but sufficient to say this is not identical to a controlled foreign corporation. Otherwise, they would have used the words controlled foreign corporation. And what kind of taxpayer can take advantage of the dividend received deduction? The answer is a domestic corporation, not anybody, but specifically a domestic corporation, which is a United States shareholder. So it's a subset of United States shareholders, so that's slightly different. And the type of corporation from which the dividend is received is a slightly different type. So here's my little 2x2 graph because I love these. So you just do the quickie comparison. So, and the reason I'm telling you this is because it's too easy for us just to get rules of thumb stuck in our head, quickly cut to the chase, and just assume that when we're in Form 5471, we're always talking about United States shareholders and we're always talking about controlled foreign corporations. And their answer is most of the time we are, but for certain situations, we got to be careful and we got to look at the rules and say, oh, actually, it's slightly different here. So this is one of those situations where you got to have that, oh, actually moment in your head. Now, with all of that background, let's go through the steps that you take from getting a giant blob of accounting data from the foreign subsidiary all the way until you've calculated the gross income inclusion that we lovingly call global intangible low-taxed income. And it's a series of subtraction steps, and we'll talk about what happens at each step, and we'll show you what happens on the forms. And we're going to be in Schedule I-1, and we're going to be in Form 8992. Those are the two forms where all the fun and games happen. Now, how does this income inclusion happen at all? Start with what you know about Subchapter C and how C corporations are taxed. C corporations are completely separate taxpayers from the shareholder, and a shareholder has no participation in the income, expenses, anything going on inside a C corporation. If a shareholder wanted to have a pro rata share of income, they'd make an S election or they'd use a partnership or something like that. So C corporations are their own thing, and shareholders have no taxable income until there's a distribution to the shareholder that is a dividend or it is deemed capital gain. And the treatment of distributions from a C corporation to a shareholder, you can tell when it's taxable, when it's just return of capital, i.e., eating up basis, and when it's capital gain in Section 301C. Anyway, so that's the base rule. And this is another example of where the government puts in a simple rule, subchapter C, C corporations are their own thing. And then they go, well, actually, that's bad. And we saw that last month with subpart F income, where people were using this to their advantage by putting passive assets in foreign corporations and deferring tax forever and ever. And the government didn't like that. And so the US government does not have enough and big enough armies to go impose US income tax on French and German and Burkina Faso corporations worldwide. There's such a thing as sovereignty of nations. And so the government can't tax a foreign subsidiary, even if it has 100% US shareholders directly. That's just the way international law generally works. But what the Internal Revenue Code can do is tax the shareholder, because the shareholder is a US person. And the shareholder is subject to the loving reach of the United States District Court. And a judge can say, hey, buddy, your money or your life, and that taxpayer will pay the tax or go to prison. So there's an incentive there. And so therefore, the blow through for subpart F and for 951 Cap A is we're just going to create a fiction and we're going to impose the tax liability on the US shareholders, and we'll figure out how to even it all up later, by giving people basis and things like that. So it's just a hole in subchapter C where we're ignoring subchapter C because it's expedient for tax collection purposes. 951 Cap A, here is the sequence of events about how things work. We're going to start with the gross income of the corporation. We're going to do a subtraction, and we're going to end up with this thing called gross tested income. We're going to do another subtraction. We're going to end up with a thing called tested income, which is really net tested income. And then we're going to do another subtraction, and we're going to end up with global intangible low-taxed income. And that's the number that flows over onto the income tax return of the shareholder. You can see in the little pink boxes on the left, these subtraction things. So the boxes with the white background. So the first subtraction we're going to do is in gross income, there are a whole bunch of different categories of gross income. Some of them already have rules for taxation, like subpart F income. So we don't want to double tax them. So we're going to exclude those from the calculation that eventually ends up in global intangible low-taxed income. Then we're going to drop down a level, and we're going to subtract allocable expenses and taxes, because after all, the income tax rules are on net income, not gross income. So we have to deduct the right expenses and taxes from whatever income we're dealing with here in order to move on to the next step. And then after that, we have this thing called tested income. And up to now, this is very basic accounting, frankly. I mean, it's no big deal. Now we come down to, finally, this is where Section 245 Cap A and the dividend received deduction comes into play, and it actually matters, because we're going to take this net tested income and we're going to allocate it between a type of income called net deemed tangible income return. And that's just a completely arbitrary number, which is just 10% of depreciable assets, basically. And the remainder, because remember, it's always a subtraction, is going to be this global intangible low-taxed income. So that's the sequence we go. And it's interesting to note that where the dividend received deduction ends up And that little box called net deemed tangible income return, that's going to be earnings and profits in there that you can now pay upstream to the U.S. shareholder, and it's going to be protected from inclusion in taxable income as a dividend in the shareholder's tax return by Section 245 Cap A. So that's the sequence. Let's walk through and talk about them a little bit at a time. Starting at the top with gross income. I'm going to use this as just my very simple financial statement: 20,000 of revenue, 2,000 of depreciation, 1,000 of interest expense, pardon me. Net income, $17,000. So let's start at the top. How do we know what a CFC's gross income is? The basic rule, and you can take this to the bank pretty much across the board. It seems counterintuitive, but why should you be applying U.S. tax law to foreign corporations with foreign business activities that never touch the United States? Yet you do. And here you can see the explanation specifically for global intangible low-taxed income purposes, why this is. So you see the regulations at the top, first bullet point, 1.951 Cap A-2C2I. This is telling you to use the same rules as you use for computing a CFC's subpart F income. Fine. And then down below, and I've given you the quote there from the regs. And then you go over to the subpart F income rules, and it says, hey, for purposes of calculating subpart F income, just pretend the CFC is a domestic corporation and proceed accordingly. And so this is why this is the justification for imposing U.S. tax principles on a foreign corporation doing foreign business and blah, 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 blah. The other meta thing I want to show you here, for those of you who struggle a little bit with understanding how the code and the regulations all bolt together. See, we're trying to figure out something that a tax imposed because of Section 951 Cap A, the new thing for global intangible low-taxed income. You're not allowed to just import rules willy-nilly from other parts of the code unless they tell you to. So here specifically, the regulations for global intangible low-taxed income is said to you, you are told to go use these rules that happen to be living in subpart F land. And you say, okay, I've got explicit instructions to go use those rules. But without that explicit instruction to import those subpart F rules and proceed accordingly, you're not allowed to use them. Most of the time, the instructions are explicit, either in the code or in the regulations. So another example is attribution rules and constructive ownership. Section 958B says, go over to Section 318 and use those rules to figure out constructive ownership for CFC purposes. So there's another explicit reference. Every now and again, there's an implicit assumption that you're going to go elsewhere to find definitions. Like throughout here, it says corporation, corporation, corporation. Well, what's a corporation? Well, you have to go look at the definitions in 7701. What's a foreign corporation? Again, you have to go look at Section 7701 for what's domestic or foreign. So anyway, you cannot assume that a definition in one part of the Internal Revenue Code applies in other parts of the Internal Revenue Code. Where does this show up on Schedule I-1? There, line 1. So you've done your math and you've said, okay, under traditional corporate accounting principles, this is what my gross income is, 20,000. Boom, we've started here. Now, Schedule I-1, this is the CFC level. We're not talking about shareholder level at this point. We're talking about CFC level calculations. Now, we've done that first step and we've figured it out. Let's move down to the second step where we're going to identify a bunch of exclusions, and then we're going to find a remainder, and that remainder is going to be called gross tested income. And this is on lines 2, 3, and 4 of the Schedule I-1. So let's take a look, and this is going to give the easiest example of what these exclusion means. And in my example, I don't have any of these exclusions because that would make the example more complicated and burn up more time. But you can see that looking at line 2A says effectively connected income. Well, we know that effectively connected income, this is income earned inside the United States by a foreign corporation, is subject to tax on Form 1120F. So we don't need to worry about imposing tax over here under the Section 951 Cap A Global Intangible Low-Taxed Income rules because it's already being taxed. So let's take it off the table. So you take that off the table. Similarly, Subpart F income. We know that Subpart F income is already taxed because of the rules in Section 951. So we don't have to tax it again here. The government's already going to get its dollar of tax revenue. And then we go down the rest, and I'm not going to bother with those. But that's the idea here. For each of those, you will be able to identify an existing method of taxation in the Internal Revenue Code that is highly satisfactory to the US government. So they just want to leave it be. And we're just adding on this new system, Global Intangible Low-Taxed Income, to catch whatever else is happening inside the foreign subsidiary. Talk a little bit about strategy here. You got $20,000 of gross income. Let's say just heroically that it's rental income, and you might choose to take the position that you're in the active business of being a landlord, and therefore this is active trade or business type of income. Or you could tilt the balance a little bit and you say, oh, I'm just a passive landlord and I'm collecting passive rent, and therefore it's Subpart F income. At the margins, you're going to come to a decision. Can I push water uphill and make this 20,000 flow downstream to global intangible low tax income? Or should I make it move the other direction and flow downstream into Subpart F income or high tax exception income or something like that? And you're going to be doing that because you're going to find a net benefit. And remember, in my hand wavy explanation of Section 951 Cap A and, why it exists, where the government opens a wide door with Section 245A, zero tax on foreign profits, closes the door partly, reopens, closes, reopens, closes. If you play to make these decisions, now you're going to be getting down into the weeds of the technical stuff. So just to give you an example, indirect foreign tax credit with Subpart F income flows up at 100 cents on the dollar. Indirect foreign tax credit for global intangible low tax income flows up at 80%. So there will be idiosyncratic situations where it's good for you to go one way or the other. And make a decision. Later in this series, we're going to have some strategy discussions, but I just want to say this is where you're going to have some interesting strategy discussions. But remember, ultimately, you're looking at the delta between the tax rate with and without. And if the government's done its job well enough, they've sliced the pie into such a tiny slice that the next net tax benefit for you, one direction or the other, is approximately equal to the friction costs of you implementing that solution. And so you say, I don't care. I'm just going to leave it as is and keep it simple. Because ultimately that's what they're doing. They're not trying to get perfection. They're just trying to create enough friction so you do what they want you to do. Gross tested income. So this is going to be the deduction. We've deducted away Subpart F income. We've deducted away all the other stuff, and we're ended up with this gross tested income. We can see here where it is on line 4, 20,000 minus 0 equals 20,000. That's unremarkable. Now, the next step. Net tested income. I put net in brackets because that's what it is, and I like to remind myself what I'm talking about, but the definition in the code is just tested income. So it's gross tested income minus allocable expenses and minus allocable income taxes. So this is where we are. And this is what we're going to be doing. You're going to be going back to the accounting data, and you're going to be looking at the expense side of the data, and you're going to say for each expense, should I allocate this to the category of income that was excluded as subpart F income? Yes, no. Was it excluded as high taxed exception income? Yes, no. Was it excluded because of effectively connected income? Yes, no. So you're going to allocate the expenses and taxes across all of those exclusion categories, and whatever is left over, by definition, is going to be allocated to this blob of income of the foreign subsidiary that's going to end up being called global intangible low-taxed income. And here's where it is on line 5. In my simple example, this business has only one line of business, and it's all of the same type. It's not excluded on line 2. So we're going to allocate 100% of the deductions to this gross income of 20,000. And you can see on the next line, jumping ahead, we have tested income of 17,000, which again is an unremarkable deduction. This whole exercise is something that you do again and again and again in tax law. You know, how do you allocate a deduction to the right category of income? First, you decide whether the deduction is allowable or not, and you use just the standard deductibility rules that apply to a domestic corporation. And then after you've done that, you're going to allocate the expenses among the 6 categories, the 5 exclusions and the remainder, which is gross tested income. And there are allocation rules that tell you what to do when you can specifically tag an expense to be allocable to one type of category. And there are rules to say, if you can't specifically tag it to a specific category, here's how you allocate it amongst all the categories. So all of those rules are there, and we don't need to get into the weeds on those. But this is a fairly standard calculation and spreadsheet game. Again, we end up with a remainder. We've allocated the expenses, $3,000 in my example, and we've ended up with an item called tested income. And that's on line 6, $17,000 of income so far. Here's where it ceases to be easy. What we're going to be doing now, and from now until the end of my little example, is we're going to start to see the effect of trying to fine-tune this dividend received deduction so that it passes enough but not too much income upstream to the U.S. shareholder. And so just for clarity, line 7, tested foreign income taxes, I have assumed that there's zero income tax liability here because I wanted to make the line simpler. That's why it's empty. We will talk now about line 8, qualified business asset investment, and line 9, qualified interest expense. Line 9, interest expense, where you're going to end up with a different thing called specified interest expense. And this all has to do with allocating that tested income between net deemed tangible income return and global intangible low-taxed income. First, let's take a little side detour because we'll need to start filling in Form 8992. You're going to take this net tested income amount over to Schedule 8992 because Schedule 8992 is the shareholder level calculation of the income inclusion. So again, Schedule I1 is the company level and 8992 is the shareholder level. For this example, I'm assuming 100% shareholder, so the numbers are going to be the same. Now let's get down into the hard part of the hard part. So everything up to now has been fairly straightforward and follows along general tax principles and tax accounting principles for how you allocate deductions and blah, blah, blah. Now we're going to get into where the government fine-tuned the tested income, which functionally is equivalent to E&P for the subsidiary, to decide how much is going to get taxed and how much is not going to get taxed. And what you're going to see from now on out is a completely arbitrary, made up thing. Let's just not use a potty mouth word here, Phil. And if you read the committee reports and the legislative history for Section 951 Cap A and the Tax Cuts and Jobs Act and why they did what they did, they say flat out, well, we looked at a whole bunch of different ways to make this thing work, and all of them were administratively too cumbersome. So we just arbitrarily are going to use this 5-pound sledgehammer and beat this peg into the ground with it. And they made up numbers, and they made up the basic numbers for how much you end up for this calculation, net deemed tangible income return. It's an income item made out of balance sheet numbers. So let's look at this. How are we going to calculate it? And this, again, I want to step back one more time. Probably not one more time. I'll probably do it again. Let's get meta for a minute. Say, if all of the tested income was included in gross income, like 100% of it, then it's just like subpart F, isn't it? Right? You've identified some net income at the CFC level. We're going to include all of that E&P in the shareholder level and on the income tax return, and the shareholder is going to pay income tax at this point. So the functional difference between global intangible low-taxed income and subpart F income, if there was total inclusion of this income, would be none. There would be no reason for this new system. By contrast, if 100% of the tested income is excluded from gross income by the Platonic ideal of the territorial tax code, then the tax rate on this tested income is 0, and the taxpayer is going to try to rearrange his, her, and its life to move everything offshore, generate profits offshore, and have 0 U.S. tax liability. So Section 951 Cap A is an attempt to find this arbitrary ground and say some of the E&P is tax-free, some of it is taxable, and the tax-free part is this net deemed tangible income return thing. So here we go, tested income. Just to remind you, we're dividing tested income into 2 pieces here. And look on the label of this tax law, and global intangible low-taxed income. Look at this phrase, net deemed tangible income return. It's really a magician's game. They're not really caring so much about tangible or intangible. If you read the legislative history, what they were concerned about was movable assets. Can you easily move this asset from one tax jurisdiction to another? Can you move it outside the United States? So the classic idea is indeed intangible assets, right? So a patent, a copyright, can you move that to an offshore company and then exploit the patent and earn foreign royalties? That's intangible income. Tangible income, I've got a bulldozer sitting here. I want to use that bulldozer to do some construction work in Burkina Faso. I can move that bulldozer to Burkina Faso, but it's some work. But if I did that, the government would say, okay, fine. But they're assuming that you're not going to move a bulldozer as readily, or you're not going to think about it for tax purposes as much as you're going to think about it for real business reasons. And so this, if you keep in mind the movable, immovable assets, you buy them and you put them in place because you need them for business reasons. Immovable ones, you do that. Movable assets, you move around, and the assumption is you're doing it for tax reasons. So here's where the arbitrary stuff comes in. This net deemed tangible income return is an assumed income item. And it's assumed, you say, well, how much income? Well, I'm going to make it up. And they make it up by saying, we're going to assume that you put into service some depreciable assets and you generated a given profit margin on the use of those depreciable assets in a trade or business. And they have assumed, they've decided that the average investor would want a 10% ROI on assets. That may or may not be a reality, but it's pretty clear in the legislative history that they just pulled this number out of their behinds because they needed a number, and 10 sounded like a reasonable number. A real investor may or may not care about this. And side note, if you've got this calculation is based on depreciable assets, because it's 10% of what, right? Well, it's 10% of the adjusted basis of your depreciable assets. If they're really caring about immovable assets, no, you made an investment in another country because you needed the assets, the hard assets there. Why didn't they include real estate? Land is pretty hard to move from Brazil to Burkina Faso. Last time I checked. It be that as it may, I'm just telling you this because I want you to understand there's no reason for this except expedience, and they decided this is the way it's going to work. So at a very simple level, just think of net deemed tangible income return as 10% times adjusted basis of depreciable assets. And that's what it is. It's a made up number, and that's just an assumed number for the profits of this CFC that would be generated by sane business people making sane business decisions in the abstract without considering tax consequences, if you want to think about it that way. And so that's good profit as far as the government's concerned. And because it's good and it's blessed, we're going to allow you to calculate that number and bring it home to the United States tax-free. And everything else, we assume that you had ulterior motives to generate an excess rate of return, and we're going to tax you on that. And that's global intangible low-taxed income. Like everything, there's the potential for abuse, right? So if you're going to use 10% of adjusted basis of depreciable assets, well, here's an idea. Let's go busy buy a whole bunch of assets on December 31. And they say, nah, we don't want you to do that. So in order to prevent you making decisions based on tax motives, we're going to make you do quarterly calculations of adjusted basis and use that average and multiply that average by 10%. And that's your net deemed tangible income return. I have to think about it every time. So, and that's the money that you can bring home tax-free. So again, they're trying to make it more expensive for you to do clever lawyer tax tricks. And at some point, you just give up and you say, okay, Uncle Sam, I'll play the game your way. Fine, here's my money. So the asset base is this thing called QBAI, qualified business asset investment. So it's depreciable assets used in trade or business. And you can see the definition there. And that number is calculated. This is the whole calculation to get from the top line down to the net deemed tangible income return, the income proportion of E&P that you can take home tax free. So you take your asset base, you multiply by 10%, and you've got your deemed tangible income return. And you can see this 18,000 number is just a completely arbitrary made up number that I put there because you need a number. But you'll see how it comes in. And so that would be the average over the year of the depreciable assets owned by this CFC, calculated quarterly. Oops. There we go. Now we come to the point, remember we calculated deemed tangible income return. So that's just the raw adjusted basis quarterly average adjusted basis times 10%. Now we go from deemed tangible income return to net deemed tangible income return. What's the net? Well, this is the part where the government is trying to dissuade you from playing fun and games with debt. So you're not going to borrow a bunch of stuff, borrow money, buy a bunch of depreciable assets, increase that QBAI number to the sky, multiply that by 10%, and thereby exempt most of the foreign subsidiaries' taxable earnings and profits from any income tax. So this, again, is a defensive maneuver by the government, closing the door a little bit more. And remember, I had $1,000 of interest expense. Just assume that it went to a bank. So you can see on line 3A, that $1,000 went in there. They net the interest expense against interest income. And this is interest expense and interest income allocated to this bucket of gross income of the CFC to come out with this item called specified interest expense. And if you look at this part 2 of Form 8992, you'll see we started at the top with net tested in the net CFC tested income, 17,000, which was 20,000 gross minus 3,000 expenses. We did the deemed tangible income return of $1,800, which is 18,000 times 10%. And now we're reducing that tax-free component by the full boat value of the interest expense that was embedded in that line 1. And if you see down on line 4, we end up with the net deemed tangible income return. What this means is you can play with the numbers a little bit, and you can look at a CFC that's really asset heavy. A factory owns a factory or owns a lot of machinery or whatever. Or you can look at a CFC that is very hard assets light, like this one. You can see that the amount of income in my example of $800, which is not included in global intangible low-taxed income and is therefore tax-free, is pretty damn small. So there's where the net deemed tangible income return is, $800 in my little example. And when a dividend is paid upstream from the CFC to the parent company, they got 17,000 cash in, well, I got 18,000 cash in the bank, 19, because 2,000 of that is depreciation. Anyway, the cash paid upstream, 800 of it will be tax-free. The rest of it will be taxable. So global intangible low-taxed income. Remember, we've taken away the net deemed tangible income return. And we end up with the remainder as the global intangible low-taxed income. And going back to the games, the fun and games, on line 2, we talked about fun and games where you say, what happens if I, through manipulation of the facts, can convert income from gross income that flows to global intangible low-taxed income into gross income that happens to be subpart F or high tax exception income. So there's one gaming possibility. Frankly, I don't see a lot of gaming possibility for CFC expenses and taxes allocations. It is what it is. You're not going to spend money arbitrarily just to load up on one side. I mean, it's a mug's game. But there's a lot of gaming possibility with the net deemed tangible income return by buying tangible assets, thereby creating higher adjusted basis and thereby having more income be exempt from tax. But in any event, we come to this global intangible low-taxed income, which is 8992 Part 2, Line 5, and that is ported directly over to the corporate income tax return or the individual's tax return, and I give you the line numbers right there. And once it's in gross income, then more fun and games happens. So there's global intangible low-taxed income at the bottom of part 2, on line 5, 16,200 is going to move over to the income tax return of the shareholder. Now, just because the global intangible income lands on the tax return doesn't mean the game is over and you've got 16,200 times 21% equals whatever it equals for a tax liability. There is another made up tax deduction here, Section 250. This is not for anybody. This is only for domestic C corporations and individuals who make the Section 962 election. The impact of this is to say this global intangible low-taxed income that comes in, you're going to have an immediate and offsetting 50% deduction. So 16,200 of global intangible low-taxed income included on your Form 1120 immediately reduces by 50% to 8,100 of global intangible low-taxed income times 21%. And so the effective tax rate on that income inclusion for that C corporation will be 10.5% rather than 21%. This number is going to decrease to 37.5% in 2026. I assume at some point it'll evaporate entirely unless the government changes the tax rules again. And here's where it all happens. I haven't filled in this form, but you will do the calculation and create your deduction. In this case, part 3, line 29, the very last line at the bottom. And that deduction will port over to Form 1120 Schedule C to offset 50% of the global intangible low-taxed income inclusion. So there we are. There's overhead overview of the complexity. And let's say, what can we say? Treat this Section 951, as I said, as a method to increase the cost of offshore structuring to a low enough point where it keeps U.S. multinationals competitive, but a high enough point so that the U.S. multinationals don't just loot the U.S. tax base and move everything overseas. That's the whole game here. And for what it's worth, you know, I've been really high level on this and I know it. And there's so much detail here. I don't know how to cover it in an hour. I would appreciate emails telling me if there's any appetite for nerd level net deed, DTIR calculations and stuff like that. So I know whether there's enough people where it's worth me putting the time and effort into preparing a presentation. But in any event, let's cut it off here, take a couple-minute break and sign off and let Elaine go off to lunch. And then afterwards, we'll come into the new Zoom channel that we're spinning up, and that link should be in the chat. And you can join, and we'll do Q&A for about half an hour on whatever you want to talk about, whether it's 951 QBAI or something else. Anyway, there we are. Here is the outro. Next month, we'll be talking about distributions from CFCs to U.S. shareholders and how that creates tax or doesn't. If you're not on the mailing list, go to hodgin.com and sign up and get the newsletter every other Friday, please. And if you're already on it and you're getting this stuff, tell your friends. There we are. Talk to you in a couple minutes over in the other Zoom room.